we will discuss about developing a financial planning for your trading, because financial plan can be allocated in every aspect of your activities. Even if you're a salary wage worker, you can also develop a financial planning, how you earn a salary and how you spend your money. Then if you're a business guy, you also need to develop a financial planning on how you can be able to allocate your money accordingly and spend it. And in trading is one of the critical area where you need financial planning if you want to scale in trading. That's one of the critical areas you need to develop financial planning, and which most traders don't really have, or most investors don't understand. So please pay attention, because the concept of this teaching will let you know exactly the concept of trading, because this is how where the conflicts always come in for a lot of people who doesn't really understand the applicable models you should use in this type of trading. And if you miss the application of the model of approach, it becomes difficult for you to succeed. So this will be like a practical guide for you to have a safer trading decisions, and it will help you to be profitable. Then, so it will be like a 30 minutes presentation. Then we could ask a question before we go into the weekly trading outlook for the week. I hope that is fine. So if you're in a very comfortable place, we could make it very much interactive so that you can be able to enter well. Don't just be watching the screen I'm sharing with you or listening to me, you know. So one of the things you need to do to develop a financial plan is to, first of all, if you come to trading, you define the purpose. You define the purpose of why you are trading, or the purpose of the money you want to make in the trading. Now, this purpose can be long-term capital growth or diversification. So these are the two ways people grow their money in the financial market. They want to grow their capital. Some want to diversify it. We call it capital growth investment or value growth investment. Do you understand? This is very critical. Capital growth investment. Many people don't understand the two, how to like use them. A lot of people are already used to capital growth because it's easier for them to understand that I put $1,000, it's now $1,200. That's capital growth. Or I put $1,000, it's now $2,000. That's capital growth. There's also what is called value-based or value growth. Value growth investment or diversification investment is another approach suitable for this type of trading. And if you do that, it will help you. Some people who are using capital growth approach find it difficult to, to scale, especially when the capital is not growing. And sometimes in the financial market, the stock market, traditional stock market, and the derivative futures and all of that, it's not necessarily a market where you grow capital. Rather, it's a market where you make a passive income. Please take note of that. It's not necessarily where you grow capital. Rather, it's where you make a passive income. So most investors are globally, they adopt the approach of value growth instead of capital growth. I don't know if I'm making sense. Do you understand? So by the time I go deeper, you'll be able to know. I just want to be hearing someone who is very, very inclined with me, so I will know when I'm disconnected and when I'm connected to you guys. You know what I mean? So now, there's also what is another thing. Okay, perfect. And another thing that you need to know about financial planning, like or setting up a goal, is to set a target. For example, you can set a target of 3 to 5% return, and also avoid unrealistic goal. This is whether you are doing trading for yourself manually, or you are using automations or third-party platforms to make executions. So you need to set up what is called a target. This target could be an ID target. It's difficult for brokers to give you a target. Sometimes an individual trader can give you a target, but those things can be an ideal. It's not that some of them will not give you a guaranteed target, which is unethical in the market. It's difficult, or let me say, it's unethical for any good trader or any experienced trader to give you a guaranteed target. It's not possible because the person is not the owner of the entire market. It's difficult for him to use that kind of approach. Although that is why some inexperienced investors or unlearned investors expect, which can never happen in life. There's nothing like guarantee. but there's possibility of making good amount of money. Now, another thing you need to know, this is very, very common with people. Yeah, of course, you can have a short-term goal or medium time or long time. And this is when we say it's common, people know about it, but it's sometimes difficult for them to approach it. A lot of people want to put money today, they start making money every hour, every week, like this kind of pressure coming in. So if you don't have a financial plan, and you may not be able to know the best possible approach to use in developing, in making a good amount of return in your trade. Now, I give you guys some about 4 levels of approach we use in developing a financial planning in the area of trading. One is what I discussed with you now. Diversification approach is the best one. Diversification approach, that is one of the best approach, where we diversified into different kind of classes. It helps a lot if you diversified. Do you understand? Now, the reason is simple. Let's say you focus only on oil, and in a week, oil market is not doing well, or in a period of time, it's not doing well, it's not going according to your directions, or according to what you have analyzed, or a prediction, or your expectation. You may have problem, you may struggle to scale, you may struggle to do other things because there is no diversification. You tie yourself to only one source of income in the market, while there are a lot of approaches you can use, other market flow, which you can use. Now, this diversification is what I also call value-based, not capital-based, because when you diversified, capital may not necessarily be accumulating, but you'll be making income from different sources. Do you understand? Now, your money have been allocated into different projects to yield returns. That's diversification. So you can only know level of your sources at the end of the day, or like that day could be a quarter or a week or a year. When you now do your summary, you do account audit to know how much value you have earned, how much profit you have made from all this investment, and how much you'll be able to withdraw. Then at the end, you can now say, okay, I am making profit, or okay, you can say I've broken even. That's what we usually use. There are some of the big companies that have been doing business for a long time. They can just be doing business, but they may not be running at profit. They may most likely be running at loss. But because they give themselves a long-term approach and they diversify into other stream of income, at the end of the year or at the end of the quarter, they can make their own audit and discover that they're on profit. Now, if they have put their money only on one source using a capital growth approach, they may not be able, they won't be able to scale in that regard, because something may just happen and it will be a problem for them to come out of it. But whereas diversification, there will be chances of creating alternative source of income from different angle. Now, do you know that in trading, capital is always at risk? Have you all seen this thing before? Maybe in any website where they put this statement, capital at risk. You guys should talk to me. Someone send me a message.
No, sir, I've not seen.
Jerry has to say yes. So you have not been visiting any forex trading website or stock market website, even this crypto, because any of the companies who does all this stock trading and everything will always put a disclaimer, capital at risk, or they can make it in a long statement, trading forex and leverage product has a risk to your investment, blah, blah, blah. Yeah, it's like a common requirement that each of them must put, whether the company is regulated or not. You have to follow some of the certain criteria. Do you understand? Now, I want to expatiate more on this thing, why they always say that capital is at risk. The reason is that when you come to trading, the capital, which is most likely your balance, is not constant. It's not locked. It fluctuates. Whether somebody's running on my screen, something Please don't draw on the screen, please, so that you won't distract us. Amos Arena. Please don't draw on the screen, please. You hear? So when you are trading, you see that there's always the capital is not constant. The trading on your account or the money you put, the initial deposit that you deposited is not constant. Because of when you're making profit, it will fluctuate. When you're making losses, it will fluctuate. That is why the brokers usually give their disclaimer, capital at risk. So in trading, what is even considered as a capital is equity. Please take note. What is considered as capital is equity, because equity is what you have left at all time, not the amount of money that you put. So that's why using value growth approach or diversification approach is one of the best approach in trading, or rather capital growth, because of your capital will always fluctuate in the sense that the companies who are like the investment you have made or the shares or the commodities or the positions you have opened in the market, you're going to use the capital to open them. And so because of that, capital fluctuate. It's not static. So you can fluctuate higher than what you deposited, or you can fluctuate lesser. And the different stock, different position, different instruments you are trading, you can be giving you profit on different times. So you may be on three or four trades today. Out of that 4 trades, 2 will be gaining, another one will be losing. Does not mean that you're not making profit. You're making profit in some of them, you're making loss in some of them. Or it could even be one position that may be at loss. As you can see, this position now is at loss. Tomorrow it can be at profit. That's why they say capital is at risk. Capital fluctuates. So since capital fluctuates, the best approach to this business is not capital growth. We use diversification approach to make profit or to draw a plan according to the nature of the business or of trading. Do you understand? Now, the formula 2 is that you have an idea or have an ideal expectation based on your financial need. Now, this is very, very important. This is the point I'm making. Every other one that may not concern us. You see, this area now is where we apply a trading plan or a financial plan. For example, let's say you have an account of $5,000 and you want to be making 5% or 10% per month. That's about $250 to $500. That's a financial plan. Do you understand? Let me talk to Felix or someone. I want to hear someone. Also, here is my major point I want to make.
I'm following. Yes,
yeah.
we are listening.
Okay, yeah. So the first form of financial planning trading is to have an ideal returns or an ideal income you want to be making per trade. For example, you have an account of $5,000. You can put yourself on a target of 5 to 10%, either weekly, monthly, or quarterly. But you know that you can make it weekly. There's no need of arguing about it. All of us know you can make 5% a week. The only thing is that it cannot be consistent. Sometimes, if you listen to my teaching, I used to tell you that it can make your yearly or monthly return in a day. Let's say you have an ideal return of 5% per month, which is $250 per month or $5,000. You can get that target within a week. That is a financial plan. You have already put yourself on that plan. I'll be earning $250 per week or per month, or I'll be earning $500 for this. Around 2019, that was the target 2018, that was the target I was using then. I was targeting about $1 million, ₦1 million that was around 2017 rather, ₦1 million per week. And I was meeting my target. When I was teaching my pastor, I put my pastor into that same target because I told him capital does not stay static. You have to put yourself on a target. How much can you be generating? So we now draw a plan, the possibility of getting that amount of money, even if the capital drop, our possibility that any single trade that gains will most likely give us similar amount of profit. From there, he put himself on 500,000. I see that he's making that money. He increased it to 4 million. And we are making about that money anytime. Remember, I told you it's not consistent. Anytime our market gained, he's most likely going to gain similar amount of money because the capital we have invested and the risk we have applied into trading, anytime the profit comes, it's most likely going to come within that same particular amount. Then if a trader that didn't gain will also have to lose a certain amount. That's the financial planning and trading. So you first of all have that idea. If I want to discuss with you about trading, I always ask you, how much do you want to be making? And how much capital are you coming in with? Let's see if it's a possibility to achieve that amount either on a low risk trading, medium risk, or high risk trading. Then we try to know if that will work for you. Some people want to put $500 or $100 to make unrealistic return. There's no doubt about it, but it's also part of the plan which you have to consider whether such plan is realistic or not. Do you understand? This particular area now concerns us who are traders. Now, okay, but balance in trading can be constant. I've said that a lot. So now, what I mean here is this. You see this history I'm sharing with you now. This is a trading history. Let's assume the previous slide was a balance with this history. You could see there is also profit, there are losses, right? There are about 2 losses here, and how many profit? 1, 2, 3, 4, 5, 6. So that's six profit and 2 loss. That's about 8 trade that I've made on this account, and this is the loss. And if you check the profit, they have similar amount of return, like their return are similar based on the volumes. And if you check the losses as well, you see that the losses are also similar. That's the plan. Because mathematically, trading success is very, very realistic when you are trading, because trading is mathematical in nature. Account that will give you $100,000 will always be giving you $100,000 at any time you gain that profit. Account that will lose that amount will also lose it at any time market goes against you. So having a financial plan is the best way. Now, you see on this account now, this account is making such amount of return. Does not mean that it will not make a loss. So I can put myself on a plan that anytime I gain this particular amount, I will withdraw. You see, these 2 accounts that have lost also affected the capital. Capital is not constant, it fluctuates. Anyone that lost, we affect the capital or equity. Anyone that gain, we affect it. I think all of us knows about these things. But the problem some of us has is that your capital drop does not mean that you're not meeting your target. But some of us will think, because my capital drop, it has to go back to that same capital before I will assume I am making profit. No, that's the capital growth approach. It's fine if you can use it, but it's not really the best approach. I don't know if I'm communicating here now.
Yes.
Yeah, so okay, perfect. So some of us, we use capital growth because maybe 2 or 4 trades may close at loss, that equity drop to 10% or 15% low or 20. Does not mean that it will not give you the ideal profit, because having a good account is like oil well that will still be generating profit, even though the oil value or the deposit value of that oil well, the oil quantity there cannot be constant. It can be fluctuating, but it can still be meeting up your daily barrel of production. This is one of the best approach. But if you keep it there, waiting for it to grow above what you deposited for you to assume you're making profit, then you most likely get it wrong, and it leads traders into frustration. Now, this is another formula 4. You see more history. I say here, your balance can still drop, but you can still meet your expectation. You see the statement, your balance can still drop, but you can still meet your expectation. Let's say you have an account of $1,000 and you have already positioned yourself to be making $50 per week. In a month, that's $200 and average 20%. It does not mean that each week it must get $50, no. So you can use even 1 week and get the $200 on a very good market. You have met a target for the month. Then that's your ideal financial plan, and you can choose to withdraw that money and keep it aside. Then that capital of 1,000 can still drop to 800 because capital fluctuates. That's why they say capital is at risk in trading. It can drop to 800. Does not mean that 800 can never produce another $50 profit. It can still produce another $50 profit. That's why we use more of the diversification and value growth instead of capital growth. Are you seeing the reason now? Now, that $800 can still produce another $50 or $100 profit. Then, on that note, you are also meeting your target. You can trade like that for almost like a month. You see that you're still meeting your average monthly or weekly or daily return. Despite that, your capital fluctuates. The only time you can add more capital could be when you want to increase your earning capacity. Then you can add more capital, because any capital you're putting into the market, you need to have a plan and like an ideal concept of profit that can be easily made on that account. Of course, you know that in trading, if you have good capital and low risk, you have chance of making more profit. So account can trade for like a year. You see that account I have traded a year have made maybe more than 200 trade, and after that 200 trade, you have withdrawn more than 70 times, and that account is still trading. But it's not that the capital is growing, but it's still giving you profit. Do you understand what I mean? So now it's not that your capital is growing, but it will still be giving you profit. Then another thing you need to know when you are building a capital or like trading plan is this: you could make sure you use only risk capital, like I've said it, because trading, I'm sure trading is not your savings account. It's money. You already have money in your bank that you choose to deposit some certain amount of money into trading. It's not a savings account and it's not a bank account. Obviously, anybody coming into trading must have gotten the money somewhere and deposit into that trading platform. So ideally, every broker, every exchange, every financial company will assume that that is the capital you are investing into the market. Then you can split this thing into different types of portfolios. For example, some of the platform we are using can allow you to hedge your access to gold. Then you could be able to like split maybe between 70 to 80% into derivative leverage trading, which is like high risk trading that could give you big amount of profit in a short time. Then and put 20 to 30% of them on hedging to avoid account liquidation, because leverage trading can liquidate account. That's the pure truth. If that's 100% truth. Then if you are on a small, like a manual trading, you could also be able to start small and try to test that strategy consistently to know whether it's going to give you good experience. So if it didn't give you good experience, then you can leave it. Now, if you are leaving it, you may try to find another structure or another strategy that can be able to be efficient. When we say good experience or bad experience, that bad experience will always come with loss. Yeah, there's no perfect solutions. The one that work for us, we can be able to consider that one as good. But anytime that strategy changes, no more working, we find a way to make it work. That is why making a proper planning will work. For example, if you have about 20 to 30% or 50% of your account, of your money, the one you've invested, you diversify them and hedge some of them. It's also part of financial trading plan on the risk management aspect, which is not just to prevent you from account liquidation, but it can also it can also help you to make more profit, because of those asset classes can still be giving you good amount of returns anytime they perform well. You know that some of the traders, they put money only on an MT4 or MT5 platform. That's it. They try to know when it's going on, when it's coming down. Yeah, it's good, but that's not the best way. Diversifying your portfolio is one of the best way to create a decent trading plan. And it will help you on risk management. It will also help you when you, for making a return. Now, this particular one is for those of us that are manual traders. So I'm not sure it's gonna be possible for some of us because of the way we do our things. But I just presented it in a way to be like a professional standard for traders. They say traders should risk 0.5% to 2.5% of their trade. So in our teaching, when we try to see that most of our SL is about average 2.5% or maximum 5%, 2.5% and maximum 3%. That's our average risk. So it means if we are trading manually, if you're trading manually with, let me use a small amount of money, like maybe with $1,000 account. So we could be risking like 2.5% of that money, which is about $25, and maximum of 3%, which is about $30. That's an ideal way of trading. Then another way, which some of us are not using it because we use a small amount of money, is this avoid extreme leverage. It can amplify both profit and losses. So most of us don't really know much about how leverage can affect us in making profit. They can only say trading is a scam anytime you didn't give them profit. But leverage and margin become innocent. But that is the major problem we are facing, that we cannot even go against it, because that's also what is attracting investors in the market because of returns. People coming into the business of trading not because they are not aware of the risk. They come into the business of trading because of the returns. Now, but the most important thing that is common in the market, if you are a manual trader, is to determine your maximum drawdown. For example, now when we say drawdown is that I told you account of a certain amount of money that will be gaining profit. You know that account can still reduce because capital is not static. But you can have an ideal drawdown you can be able to bear. It could be maximum 20%. Some pro forma account give you maximum 6%, which is not helping a lot of traders because it's easy for account to drop to 6% or 5% and they kick out of the market. But if you have your own account, you can have about 15 to 20%. You can even have up to 30% if the risk is up by you. Then why is that? Because it will help you to give the market a balance. Sometimes it can have a run up to 10%, 15% in the market that is losing, and at the end of the market will still come back and give you a profit. So when you determine this maximum drawdown, it's also another way of having a proper financial trading plan on the risk management aspect, in the sense that if the trade did not give you the profit you're expecting, at least let it not be that you liquidated your account. For example, let's say on leverage account, you have 15 or 20% maximum drawdown, and 20 or 30% of your money has already been hedged on gold on the same market. Then you may have a drawdown on a particular position that is at loss, while the account that is hedging on gold will be on profit. So at the end of the day, you see that you have an effective risk measure. Despite that you have not meet up your profit target, but you still retain control of your capital to allow it to give you more profit. Because if you lose today, doesn't mean that you're going to lose tomorrow, or it doesn't mean that you're going to be losing consistently, unless if you do not review your strategy, try to change it to make it much better. Now, assuming you have a drawdown of 15%, and their hedging instrument gain like 5 or 6% or 8% out of that 15, you have already recovered 8% from your normal trading drawdown automatically. And if you allow that trade to continue, and your ID profit could be a certain amount of money that is very, very realistic, it is very possible that you will see make another profit, even though you have had about 8% drawdown maximum, you can still make profit again. Because of the capital in trading does not stay consistent or constant, it fluctuates almost all the time. Then another plan, I've already mentioned it technically, but for the sake of my notes sliding, I will still have to complete it. So another thing you need to know is withdrawal. So you could put yourself on a target. When I said when you meet a target, then you can choose to make sure you always withdraw when you meet a target, because unless if you're using a capital growth approach, that's when you may not think of withdrawing. But if you're using a value-based approach, you have to think of withdrawing anytime you meet a target. You can have what is called a wallet or a reserve account. It could be a bank account, it could be an e-wallet, where you can be able to mopping up your profit. Let's say you have an account of $1,000, and you're expecting, you put yourself on a target of $100 per week or per month, which is very, very realistic. It's possible. So it means anytime you're trying to gain $100, you have to withdraw. So if you continue with that systematic approach for 6 months, that is 60% return, and the account is still trading. Anytime you get $100, you withdraw. Anytime you get $100, then you withdraw. Even if the capital dropped to 80% to $800, $850, $900, it can still give you the same profit of $100. Are you getting my point? Then at the end of the day, you may discover that that same account has given you a lot of profit, and it's still trading. And it's still trading. Have you seen where you see that you build up an account grow from maybe $1,000 to $2,000, $3,000, and you didn't withdraw, only for you to see that you have lost part of the profit as well, or even if not all. As that one, have you seen such an experience before?
Yes, it happened to me.
Yeah. Do you know why? Because there's no financial plan.
Happened to me as well.
You see, that's because there's no financial plan. Account can gain good amount of return. Leave it there. So why did it happen? Because of the truth about the market. The capital is always at risk, so it fluctuates.
But it happens to me. I actually had some gain when I tried to withdraw with the Ava trade, and it was denied several times. And when the capital actually went down, and for some reason the whole amount was like 3,200 was placed on a certain amount of trade, and then there was not even a stop loss, and the amount automatically vanished like that.
It can also be traceable to the same plan, because of anytime a broker declined withdrawal, that they're most likely going to give you a reason. Yeah. So
yeah, but I think the reason, because actually the first time that I initiated a withdrawal, it was at night, and I requested a withdrawal. I think was of 2,000 because the account already have a gain of over 2,000. Yeah, and it was denying that. Let me check the reason. It was denying that it was still on a trade, but whereas it was at night, at my time, it was actually the market were already closed. So the next day I came and I initiated a withdrawal for 1,000. They gave another reason, and then before I know, about 2 days ago, they just placed the whole amount on a trade, and there was not even a stop loss on it.
One, if you use automation to trade, the best thing to do is to make sure before those account is activated, you discuss the risk. We have done that course before. They always discuss the risk approach to that account. Because of that's better, brokers keep their trading automation on default. They don't put it, and there's always like a default they put it. They don't like put it based on your preferred risk, unless the client disclose this is the particular risk I want. Because of that, the account can be gaining like a big amount of profit. It can also lose big amount of losses because of that. But where you define the plan at the initial time, tell their broker or look is exactly how I want it. Believe me, they have to put it that way. Now, but if you didn't do it that way, it will always be on default, where it could be making some big amount of profit. Before you know what's happening, it can make some big amount of losses. That's how brokers, most of this does. Because one thing about automation is that it's a bit aggressive than human trading. That's the truth. You can trade only 2 or 3 times in a week, but automation can trade about 8 to 9 times in a week. There's another thing that traders need to know about what is called conflict of interest. Is a conflict of interest plays a huge role in trading. A broker is only interested in his commission and spread. As long as he's hitting the trade, you're hitting your trade, or whatever trade is coming back to back, he's very much interested and very much happy because you are giving him commission and he's charging you more spread. And of course, they are not really financial planners. None of the brokers can easily give you a financial plan. It always comes most likely from you or from your investment advisor, because it's difficult for broker to be giving their client financial plan. So that is one of the things that contribute in traders losing money, and that's also one of the reasons why we are making this course, this class, because we see we have people, traders who have gained a lot of profit, now also end up losing it, even though maybe it could be a lot of factors. For example, you are trading, you don't have enough margin, you have made a lot of profit, and the account is still on aggressive trading. So on that note, what you can only do is to make sure that that trading system or the risk applied to that account is stepped down, where you can be able to make a consistent growth on a low risk. So even if you have a loss, it should be within the similar amount of profit you are making. Do you understand? For example, now, where we are making about 10% profit per week or per month, at least if you are losing money on a trade, it should also be between maybe 5 or 6%. Than when you're making 10% and you're losing 50%. No.
Yeah, but what I was kind of thinking is, because actually they said if you actually have some money in there, you have up to above 3 months to do the complete withdrawal. So if that is the case, I think there was actually supposed to be some kind of like them trying that the money should not, like, you shouldn't have a complete loss before the 3 months.
Now,
and then where actually it was kind of a little bit, I can't actually place it very well, is initially the trade was, they were being placed between 200 to 300, but that day why it was placed at 3,200 and something dollars, and there was not even a stop loss at any point. So that I thought maybe could it be another way that the broker just wanted to finish the entire amount of money because I was actually requesting a withdrawal or what, because that I couldn't actually reason it out well.
Many things can contribute in losses. One, you need to consider the instrument that they are placing your trade on. Most brokers will be interested in trading a high volatile instrument. So if you discover that instrument, for example, when you made a profit, check the instrument that give you that profit. If it's the same instrument that give you that big profit, it could also cause you a big losses. So now, the first thing, I told you why we are discussing this is because of the things that have happened where I can't go up, I can't come down, everything. It's important that we have this class to discuss trading plan. So if such a case come in again, you want to use the automation or you set up a system like that again, before trade will start, do you understand what I mean? Before trade will start, make sure the risk is properly discussed and you allocate your risk. Let them allocate a certain amount of risk for you. Then if the broker goes against it, you know that broker is not following what you want. Although understand, broker may not necessarily give you a risk or put, but you need to put it, you need to make sure it works in accordance with your objective at the initial time and follow that plan. Then it will help. That is the major reason why we are having these courses, this class today, to make sure that people will avoid some certain mistake that have been occurring and reoccurring. Financial plan is another way to beat it. Do you understand?
Yeah, I do understand, but it's okay. My point here is, again with the withdrawal, like with the Ava trade, I think there's a problem with the withdrawal method, because once you place a withdrawal,
on the withdrawal, make sure anytime you are making a withdrawal, one, probably there's no open trade, you have enough margin, or most likely you are using the right withdrawal method. These are things I can remember that can cause withdrawal to be declined. Open trade, not enough margin, using different method. Or sometimes some brokers, I don't know, I have to ask properly, or you can also have to ask. Some brokers has percentage of withdrawal per time. Yeah, I can remember now. A lot of brokers I know, they have that percentage of withdrawal. For example, some brokers apply this concept of not get risk pick policy, and which is sometimes legally in some jurisdictions. where you put in like maybe $1,000 and you gain unnecessary profit, they will ask you to withdraw based on percentage, because if you keep pulling in like that, it will imply that they implement what is called not get rich quick scheme policy, where some of them will have consistent amount of withdrawal, like a certain percentage of withdrawal each client will be making to balance the financial anti-money laundering policy almost all the time. Many brokers I know, I don't want to mention their name, about 5 of them I know, our clients have traded, they have that policy. Even I noticed that even someone like 6 years ago. Yeah, sometimes they also have it on card. If you use a card payment, they have a maximum limit you can withdraw, either per month, per day, and they pay 30 minutes of a time. No matter how much you have gained there, that's the amount, the how much they can allow to push into your account. So now these 3 things is another important thing. And thank you for answering these questions. One, it will help you now, and all of us here, to go deep, trying to understand all these policies on withdrawal. If there's a certain percentage that's allowed at a particular time, and if there's a certain drawdown on allow at a particular time for any broker, not all brokers will allow you to maybe put 5,000, gain 20,000, pull out 20,000. Some brokers have this policy now. I don't want to mention their name, but I know very well some of them have that policy. They may have a particular percentage that will be corresponding with the amount of money you're depositing. Even some banks, some of us, I don't know where you are, there's some bank now, if you are making a account opening, you have to disclose the estimated amount of money that's coming to the account. Every time big amount of money come that is not what you disclose, then they will flag it. You have to declare it, like prove to them where you're coming from, because that was not what you stated when you started putting their account. Let's say account that you disclose that you're receiving an average $5,000 per month, and it's coming in all of a sudden account coming $50,000, then immediately they flag it. Or if you come unnecessarily unusual, you may tell them that it's coming in every month, only for that money to be coming in every week. They flag it. Most of the banks have those systems now that flag it. So for you not to for them to comply with those, the anti-money laundering policy, not get rich quick policy, they have to implement those policies. And sometimes they may not tell you on time why they are declining it until you know. So it's very important that you follow this approach, try to know all the policies about depositing, withdrawal, and everything to help, and the risk management, important, to help a client have a profitable trading experience with any of the brokers available, including the brokers you guys are using. Make sure you go and research on that. Do you understand? There are also some brokers that have some policies that they don't easily implement until there's a time to implement it. Then they will also implement those policies.
So I want to ask a
because
question.
of time, so okay, I want to ask a question.
Does it mean that the automated trade does not have a particular algorithm that it actually uses? Like it can just automatically go right up and
It
goes down
depends.
at any time?
It depends on how it's programmed. I told most brokers automation is on default. They don't set it on anything. It is when the broker, when the client is onboarding, the client can be able to, ask some questions to disclose a particular thing. About, for example, I told you about conflict of interest. Brokers like to get big volume. That's the truth. They want to get big volume. They want to get big trade so that they can make commissions. Yeah, that's 100% truth. For example, account that gain 2,000, that broker may have gained up to $200 profit commission from it, and he wanted to continue. So it is the trader that will be able to ask those questions. How does this thing work? How does the algorithm work? How does automation work? So now at the end, it will be able to you'll be able to make an informed decision. I read an article by, I think, FCA. They published it 2 months ago. They asked all the brokers, all the fintech brokers that are using automation, to start disclosing the algorithm risk, how it performs, so that people will know. Because sometimes they may disclose it on their website, but people will not be able to go through those pages and read it. That's also another thing. So it's important that even though they have disclosed it, we need to ask questions. How does it perform? Which most likely going to be on default. It can say, I want it this way, I want it this way. Do you understand now?
Okay.
Yeah.
That's what.
Yeah. So okay, I've talked about diversity. Allocate part of capital into. Oh yeah, you can allocate part of capital into this, and again too. This second slide, gold spot. For example, you can allocate part of the capital into other commodities like stocks, whatever, and it shouldn't just be on leverage product. Let me use you now, my friend, who's asking me the question. How do I pronounce your name? Muya. Now, for example, let's say you have an account of $3,000, for example. You can allocate maybe 40% of it to physical gold spot. Like the gold has really done well. And some of the platforms you're using now allow you to hedge on gold, to be honest. And that kind of system, you can hardly lose your capital because they will buy the gold for you, send you the contract note. You see the exchange where that gold is located. That you can even go at their back and write to that exchange, try to confirm if they have such amount of gold allocated to your name. Yeah, it's as simple as that. And as the price of gold is appreciating, the price of course, your gold hedging will also be appreciated. So even if you have a loss, it's a big loss on your normal trading, it will not affect your entire capital. But this is a system that is very, very important. That's very, very nice, even though it's not popular. But I've not seen a system like that that could allow retail traders, prevent them from losing their entire capital in market. That I've not seen. Because most brokers will know a system does not protect you in any way. If market is going against you, to go against you to zero. Yeah, it happens a lot. But if you have a system that hedge as an institutional trader does, then fine. And you give it a long-term approach, you end up becoming a profitable trader. And at the end of the day, you remember I told you value-based approach. At the end of the day, you may discover that capital did not grow, but by the time you're pulling everything out, the value has added more than what you started with. The value. Do you understand? So maybe you've been withdrawing, but the capital didn't grow, but the value has been added. That's one thing about investment. Investment is valued based on value, or is best described by value than capital growth. Then I've repeated this one several times again. You have to spread the risk across multiple market. Let me open up for question. This is just the normal disclaimer because both manual trading and automated trading has a risk. There's no one that is risk-free. And the performance in the past, they cannot use it to talk about future return. For example, as you had a loss there, you may come back to your normal trading and see that you're gonna make more profit. The same instrument that lost money will still get money. That's one thing about trading. There's no 100% possibility of having consistent losses. I know 100% possibility of having consistent profit. Now, financial planning, risk management planning helps you to mitigate some of these things and be able to come out profitable. And of course, always trade with your risk capital, which obviously all of us are into because the trading account is not a savings account. Money has already left a savings account to this one. So is there any question? Let me give us a chance to answer the question. We have spent some couple of minutes to delve into this trading plan. So let's know that we use the remaining time now to discuss about the trading outlook for this week. Any question?
Yes, I have a question, please. Hello, can you hear me?
Yeah, go ahead. You just ask your question.